You ever wonder which retirement strategy actually leaves you with more money, the Roth or the pre-tax 401k? On paper, it sounds simple. Pay taxes now or pay them later. But when you run the math, the story changes. So today, I'm breaking down a real-world example. Two 35-year-olds, both investing $70,000 a year for 10 years. One uses a Roth, the other uses a pre-tax 401k. We'll see who comes out ahead at 65 after taxes, and I promise the results might surprise you. If you find this kind of breakdown helpful, hit the like button. It helps push this video out to more people who need real financial clarity. Now let's meet our two test cases. Roth Ryan and traditional Taylor. Both are 35, both invest the same amount. Both earn the same 6%. The only difference, Ryan pays taxes up front. His $70,000 becomes $49,000 after paying 30% in taxes, and then it goes into the Roth. Taylor defers taxes. He invests the full $70,000 pre-tax, no taxes due today. After 10 years, both stop contributing and they let the money grow untouched until age 65. Now let's see how this plays out. After 10 years of savings, Ryan's Roth grows to around $860,000. Taylor's pre-tax grows faster early, about $978,000, because his contributions were bigger up front. So at this point, most people would say pre-tax wins, hands down. But that's where most people stop thinking, and that's where the real difference begins. Let's look at the 20-year growth window. Both accounts now grow untouched for another 20 years from age 45 to 65, earning the same 6%. Roth Ryan's balance grows from $860,000 to about $2.93 million, and that's all tax-free. Traditional Taylor's grows from $978,000 to about $3.35 million. But remember, every single dollar is taxable later. And that's where the trap gets triggered. At retirement, Uncle Sam steps back in for his cut. So let's look at the retirement payoff. At age 65, Taylor's pre-tax balance is $3.35 million, but after paying his 30% tax bill, he keeps $2.35 million. Ryan's Roth is $2.93 million, and since it's tax-free, he keeps every single dollar. That's a $588,000 difference, even though they invested the same amount for the same time at the very same rate. And here's the kicker. Taylor's total tax bill ends up being over $1 million in the future taxes, while Ryan's locked in his rate decades earlier. This isn't about saying the Roth is always better. It's about control. Roth equals pay tax on the seed, harvest tax-free, where traditional equals save tax on the seed, harvest fully taxable. If you think your tax rates will be higher later or you want flexibility in retirement, Roth wins every time. If you're in a higher income year and expect lower tax rates, pre-tax might make sense. But here's the truth. Most people don't plan withdrawals strategically. They see their retirement balance and think, that's my money. It's not. It's a joint account with the IRS, and their share changes every time tax laws do. So here's the smart move. The best strategy isn't either or. It's blending both Roth and pre-tax to give yourself options later. And here's how the pros play the game. Build both Roth and traditional buckets. In high income years, lean pre-tax for the tax deductions. In lower income years, lean Roth for that tax-free growth. Convert strategically when your bracket dips. That's how you cut your lifetime tax bill and not just your next one. Now let me give you the real world side of things. In 28 years, I've never seen someone cash out 100% of their Roth. And although I use this example sometimes, I'm not advocating you do so. It's just to give us a start and a finish point to do comparisons. But I've never seen anyone fully withdraw and empty out a Roth. But I've seen plenty of people empty out their 401k or their IRA. They pay the penalties and they pay the taxes to start a business, to buy a house overseas, or to dig themselves out of debt. That's real life. In retirement, you're not taking it all at once. You're taking it strategically, year by year, to manage your tax game. But here's what I see again and again. The problem isn't not having money. It's that it's all trapped in pre-tax accounts. Every single withdrawal means Uncle Sam gets paid. And I've had clients with millions who didn't even need the money, but the IRS forces them to take it out through required minimum distributions. That's extra income triggered more taxes, higher Social Security taxation, and IRMA penalties that jacks up their Medicare costs. When you're young, it's hard to imagine these high quality problems. But I can tell you, I was the young guy stacking pre-tax money, thinking I was doing everything right. Then I realized the goal isn't to build wealth, it's to build choices. And that's the point of the videos like this, not to make Roth the hero, but to help you have options when it matters most. So I hope one day you're sitting with your advisor, high-fiving each other over the monster Roth you built, and you remember that some crazy guy on YouTube kept pounding the table about it until it finally stuck. Because truthfully, I don't see many million-dollar Roths, even among very wealthy families. And I'd love to know that something from this channel helped change that. So thanks for watching, and for more business wealth tips, subscribe so you don't miss next week's video. Enjoy your week, and I'll see you next time.